Welcome to the deep dive. Today, we're doing something a bit different. We're diving into business strategy, financial insights, and leadership wisdom.
Right. Our mission is to take what looks like a pretty dense financial document and, well, turn it into a real conversation. Uncover some practical lessons for you.
Yeah, exactly. And we've got an interesting mix of sources for this one.
We do. On one hand, we have this comprehensive list of interview questions, the kind designed to get deep insights about business, finance, personal growth, that sort of thing.
Okay.
And on the other hand, the 2004 shareholder letter from Wesco Financial Corporation, penned by the man himself, Charles T. Munger.
Munger. So we're basically going to, interview this old financial report using these questions.
That's the idea. See how, real-world business challenges and decisions, as laid out by Munger, actually answer some of these fundamental questions about success and resilience.
So what does it really mean to navigate tough times or spot opportunities or handle risk when you see it in the actual numbers, not just theory?
Precisely. We'll try to pull out those key nuggets of wisdom, help you connect the dots between, say, high-level philosophy and the nitty-gritty performance of these companies, all through Munger's, let's say, unique perspective.
All right, let's get into it then. Wesco Financial Corporation. We're looking at 2004 versus 2003 through Munger's eyes. First off, what kind of company was Wesco back then, and what's the big picture from this 2004 report?
Okay, so Wesco operated mainly through four subsidiaries. You had Wesco Financial Insurance Company. They call it WesF, reinsurance mostly.
Okay.
Then the Kansas Bankers Surety Company, pretty much what it sounds like, insurance for banks, mainly in the Midwest.
Got it.
Third was Court Business Services Corporation, big player in furniture rental, like office furniture.
Rent to rent.
Yeah, exactly. And finally, Precision Steel Warehouse, Inc., steel warehousing, specialty metals. So a bit of a mix.
Definitely diverse. And the headline numbers for 2004.
Well, this is where it gets interesting right away. Consolidated net operating income, and Munger emphasizes operating, was up.
Yeah.
Went to about $47.4 million at 6.66 cents a share, up from around $40 million or $5.61 in 2003.
Okay, so operating income up. Sounds good.
But consolidated net income, the bottom line number most people look at, actually decreased. It was the same $47.4 million in 2004, down from $74.7 million or $10.49 a share the year before.
Whoa, wait. Operating income up, net income down. How does that work?
It's all about realized investment gains. See, in 2003, Wesco had nearly $35 million in gains from selling investments. In 2004, zero. None.
Okay, so Munger making that distinction right up front. He's clearly steering how he wants shareholders to think about the company's performance, isn't he? Focusing on the actual business operations.
Absolutely. He's saying, look at the engine, not just a lucky break in the stock market. It tells you a lot about his view of sustainable value right there.
Okay, let's take some of those interview questions, like how do you identify a good business opportunity? Or how do you approach risk management? How do Wesco's insurance arms, Westside and Kansas Bankers, reflect Munger's thinking here?
Right, good question. Let's start with Westside. They're in reinsurance, which means they insure other insurers, even against what Munger calls super catastrophes, big risks.
Wow.
They participate in risk pools managed by their parent, Berkshire Hathaway, covering things like aviation risks, plane hulls, liability, even satellites. For 03 and 04, they took a 10% slice of the hull and liability pools.
And Berkshire manages those pools.
Yeah, and Munger points out that because other Berkshire companies act as intermediaries, Wesifike has virtually no insurance acquisition or insurance administration costs.
Yeah.
That's a huge built-in advantage.
Definitely. Any big events for Westside in 2004?
Yes, a significant one. They bigly terminated a big multi-year property and casualty contract in the fourth quarter. They paid out $43.1 million in cash to the original insurer.
And after that?
After that payment, Westvike was off the hook for any future losses on that contract. It's interesting, the written premiums for that specific contract actually show up as negative $2.3 million in 2004 because of this termination, whereas it was over $30 million positive in 2003.
Okay, so cleaning up the books there. What about their actual underwriting results? Were they making money on the insurance itself?
They were, and Munger uses this great phrase. He calls the results weirdly favorable in both years. A $14.6 million underwriting gain in 2004, $15.7 million in 2003.
Weirdly favorable? That doesn't sound like boasting.
Not at all. He immediately follows up by warning shareholders these kinds of results are not to be expected over the long term. He reminds them they had an $8.1 million underwriting loss back in 2001.
So classic Munger caution, acknowledging luck, managing expectations, keeping that long-term realistic view of
Yeah,
risk.
exactly. Don't get carried away by a couple of good years in a volatile business. That's the message.
Okay, what about the other insurance business, Kansas Bankers?
Right, Kansas banker Surety. Wesco bought them back in '96 for about $80 million cash. Munger calls it a very satisfactory acquisition.
High praise from him.
It is. They've been around since 1909, specializing in insurance products for banks, mostly smaller community banks across the Midwest, maybe 30 states or so.
What kind of products?
Things like bank deposit guarantee, bonds insuring deposits above the FDIC limits.
Hmm.
Also, directors and officers liability, employment practices, policies, even stuff like insurance for bank insurance agents, and, interestingly, internet banking theft insurance. Pretty niche.
Very specific focus. Did they change their strategy much after Wesco bought them?
Yes, a key change Munger highlights is how much business they started keeping for themselves. They used to cede or pass off almost half their premium volume to reinsurers. By this time, since about 1998, they were only reinsuring about 14%.
So they're taking on more risk themselves.
They are. And their results suggest they were good at it. Their combined ratio, basically losses and expenses divided by premiums, lower is better, was much better than average. 74.9% in 2004, even better at 65.0% in 2003.
So keeping more risk paid off.
It seems so. But Munger again adds that characteristic caution. He expects volatile but favorable long-term effects from holding on to more of that risk. Volatile, but hopefully favorable overall.
It really paints a picture of calculated risk-taking within a specific area of expertise, doesn't it? They know their niche, they trust their underwriting, so they keep more skin in the game.
That's a perfect way to put it, operating within that circle of competence.
Okay, let's shift gears. One of those interview questions is always about challenges. What's one challenge you faced early on, and how did you overcome it? Court Business Services, the furniture rental company, sounds like it fits this perfectly.
Oh, absolutely. Court's story in this letter is quite the ride. Wesco bought Court in February 2000 for $386 million in cash. A big chunk of that, about 60%, was goodwill.
Goodwill meaning they paid a lot more than the book value of the assets.
Exactly. They paid for the brand, the market position.
Hmm.
Court was, and is, the leader in rent-to-rent furniture. Munger even makes this analogy to Hertz selling used cars, saying Court is also skilled at selling off its used furniture inventory.
Okay, so big acquisition, market leader. But then things went south.
They really did. Court's after-tax profit in 2004 was only $5 million. Now, that was a recovery from an actual loss of $6.3 million in 2003. But compare that to the $29 million in after-tax profit it earned just in the 10 months Wesco owned it back in 2000. A huge drop.
Ouch. What happened?
Munger doesn't mince words. He says, quote, "When we purchased Court, we were poor predictors of near-term industry-wide prospects."
Wow. He just admits it flat out.
Right there in the shareholder letter. He blames the dot-com bubble bursting, the shock of September 11th, and just a long slowdown in new businesses starting up, which hurt demand for office furniture rental.
That kind of candor is pretty rare. What does that say about leadership, especially when things go wrong? Admitting you misjudged?
I think it's incredibly important. It builds credibility. He's not trying to spin it. He's saying, look, our timing wasn't great, the environment changed. But importantly, he also notes that even during that crash, Court still operated with positive cash flow. They didn't go under.
That's key. So they weathered the storm. Did things start turning around by 2004?
Signs of life, yes. Furniture rental revenues in the last quarter of 2004 were up 13% compared to the same quarter in 2003. The number of leases outstanding grew by 2% over the year. They were also put $74 million into expanding the business through smaller acquisitions, and they paid down $33 million in debt. So, making moves.
Seems like they were actively managing through the difficulty. Any other ventures within Court?
Yeah, they'd started a subsidiary back in 2001 called Relocation Central Corporation, an apartment locator service. It didn't go well. Lost $7.4 million after tax in 2004.
Another stumble.
Seems like it. Munger says it didn't progress as they'd hoped, so they downsized it, folded it back into Court as just a division, planning to rely more on internet traffic. But he adds that he still likes the idea of having relocation services alongside furniture rental.
Interesting. So the concept might be good, but the execution was tough. What about the person leading Court through all this?
Munger gives a strong endorsement here. He calls Paul Arnold, Court CEO, a star executive with a long, convincing record. Despite the rough patch, Munger clearly had faith in Arnold and expected Court's business and earnings to expand considerably at some future time.
So the takeaway from court is resilience. Acknowledging mistakes, surviving downturns, trusting good leadership, and adapting, even if new initiatives don't always pan out immediately.
I think that sums it up well. It's not about never making mistakes, it's about how you handle them and keep the core business generating cash.
All right, let's look at the last operating piece, Precision Steel Warehouse. Thinking about questions like, how do you stay motivated? Or what trends shape your industry? Steel sounds like a tough business.
Definitely cyclical. Precision Steel, based near Chicago, actually showed an after-tax profit of $1.1 million in 2004. That was a turnaround from a loss of about $0.9 million in 2003.
Like a positive swing.
But there's a footnote, as often with Munger. Those numbers were affected by a LIFO inventory accounting adjustment.
LIFO, last in, first out. That impacts things when prices are changing, right?
Exactly. And steel prices were going nuts in 2004. The LIFO adjustment actually decreased 2004's reported income by $1.8 million. There were also environmental cleanup costs. Without those two things, Munger says the 2004 profit would have been more like $3.0 million, compared to a $0.2 million loss in 2003 on the same adjusted basis.
So the underlying operational improvement was actually stronger than the headline number suggests.
Much stronger in that particular year. But Munger provides context. Before 2004, the business really struggled. Demand was down, competition fierce. Average revenues from 2001 to 2003 were down 27% compared to the late 90s. He flatly states it hadn't reported satisfactory results in recent years, even with the 2004 bounce.
So what drove that 2004 improvement if the preceding years were so tough?
Munger calls 2004 a difficult and chaotic year for steel. There was a raw material shortage, causing sharp price spikes for both raw and finished steel. Precision Steel's revenues jumped 31%, pounds sold up 14.5%.
So they benefited from the chaos.
It seems so. They were able to pass on those price increases, plus markups, to their customers. Period, which likely helped.
But even with this good year, Munger sounds skeptical.
Very much so. He explicitly voices concern that these favorable 2004 results may have been anomalous and temporary. He worries the steel warehouse business could easily revert to difficult times.
That really highlights the challenge of leading in a cyclical industry, doesn't it? You have a great year, but you can't assume it's the new normal. How do you manage that uncertainty?
It takes serious discipline. Munger again praises the leadership Terry Piper, the CEO since late 1999. He says Piper did an outstanding job leading through those very difficult prior years. The implication is that good management matters most when times are tough, not just when the market lifts all boats.
So don't get fooled by temporary upswings. Focus on solid management and long-term relationships. Any other bits to Wesco's operations?
Just minor things. About $74 million in earnings each year from rent on their Pasadena office building, plus some interest and dividends on cash held outside the insurance subs, offset by corporate expenses. And a small real estate subsidiary, MS Property Company, holding some appreciated property, not major drivers.
Okay, let's get to the heart of Munger's philosophy. Thinking about investing, finance, future vision. How does Wesco's investment strategy reflect the chairman's famous approach?
Right. So Wesco's overall net worth grew slightly in 2004 to $2.12 billion, or $297 per share, mostly from retained earnings. Importantly, Wesco carries its investments at market value, so unrealized gains are already baked into that net worth figure.
And Munger points out something interesting about taxes related to that, doesn't he?
Yes, the interest-free loan from the government. He calculates the deferred income taxes on those unrealized investment gains at about $32 per Wesco share. He stresses it's not permanent taxes will be due when they sell, but having that capital working for you in the meantime, interest-free. That's a real advantage.
Classic Munger, finding value even in the tax code structure. But then he makes this rather stark comparison between Wesco and Berkshire Hathaway.
He does. It's quite something. He states plainly that Wesco's business quality and, frankly, human quality are not nearly as good as Berkshire's.
Ouch.
Yeah. And he says each dollar of book value at Wesco continues plainly to provide much less intrinsic value than a similar dollar of book value at Berkshire Hathaway. He hammers it home. Wesco is not an equally good but smaller version of Berkshire Hathaway.
Why be so blunt? Is he just managing expectations, or is there a deeper point about where Wesco sits in the investment universe?
Both, I think. He's absolutely managing expectations, telling shareholders not to expect Berkshire-like returns. But it also explains Wesco's subsequent investment actions, or rather, inaction. He says Wesco plainly needs more favorable investment opportunities. ideally buying whole companies or finding marketable securities for the insurance portfolios.
But those opportunities weren't there.
Apparently not, to meet his standards. He quotes Warren Buffett's 2002 Berkshire report directly, where Buffett said, "We continue to do little in equities." Even after 3 years of falling stock prices back then, Buffett said, "We still find very few that even mildly interest us."
This is after the dot-com crash. They still weren't finding bargains.
Not bargains that met their very high threshold. Buffett added that the hangover may prove to be proportional to the binge, referring to the bubbly years. The implication is prices still hadn't fallen enough to offer truly compelling value.
So what's the principle here? Patience. Extreme patience.
Extreme patience is right. Munger quotes Buffett again on the required return. Unless, however, we see a very high probability of at least 10% pre-tax returns, we will sit on the sidelines. He acknowledges it's no fun sitting on cash earning less than 1% after tax. But crucially, occasionally successful investing requires inactivity.
Inactivity as a strategy, that's counterintuitive for a lot of people in finance.
Completely. But Munger says, for Wesco shareholders, the one thing that should interest Wesco shareholders most with respect to 2004 is that, as in 2003, 2002, and 2001, Wesco found no new common stocks for our insurance companies to buy.
4 straight years of finding nothing new to buy in the stock market.
4 years. That's discipline. They just waited.
Were there any investment highlights?
Well, something was happening due to past decisions. Munger mentions the announced sale of the Gillette Company to Procter & Gamble. He calls the resulting gain mere accounting, not significant strategically, but it was expected to generate a $190 million after-tax gain for Wesco in 2005 as their Gillette shares converted to P&G shares.
So a gain was coming, but not from recent buying activity.
Exactly. And just wrapping up, they increased the regular dividend slightly from 34.5 cents to 35.5 cents per share. And Munger expresses personal regret about the upcoming retirement of Wesco's president, Bob Bird, calling him his partner for over 35 years. Shows the value he placed on those long-term relationships.
What a fascinating look inside. It's so much more than just numbers. It's philosophy, discipline, patience, and that brutal honesty.
Absolutely. That honesty about Court's prospects, the comparison to Berkshire, the admission that good results might be weirdly favorable or anomalous. It's refreshing, isn't it?
It really is. So we started with these broad questions about success, growth, handling challenges, and we end up finding answers embedded in the details of a 20-year-old financial report.
Munger's candid assessments, his extreme patience waiting for the right pitch, his humility about mistakes. There are powerful lessons that still resonate today, I think.
Yeah, for you listening, this really underscores that success isn't always about frantic activity or nonstop growth. Sometimes, maybe often, it's about that disciplined inactivity Munger talked about. Rigorous self-assessment. Focusing on long-term value, not just short-term noise. Really understanding why you own something or why you don't.
And it makes you think, doesn't it? When you look at a business, or maybe even think about your own career or goals. What are the underlying interview questions you're implicitly asking? About resilience, about dealing with setbacks, about long-term vision.
That's a great point.
And how much does that leader's character, the transparency, the candor we saw with Munger, how much does that really shape the resilience and the ultimate legacy of whatever they're building? It suggests that maybe honest self-reflection is just as important in a shareholder letter as it is in our own lives. Lots to chew on there.